Thank you. Thank you very much. So we keep on going, and we've got now a very interesting session with someone who's not quite, let's say that we never, or early never, seen these type of scenarios and events. He's Marcel Rafart. He's the managing partner and CEO of Galdana Ventures. You probably heard about him. And we'll talk about some lessons that we can learn from one of the biggest and most global investors in VC. He will bring today, and he was telling me, very privileged information, something that, well, it should not be shared, but he considered that it's interesting to share in a session like this because it can be really enriching on how they work, demystifying some myths. So let's welcome to the floor to Marcel Rafart from Galdana Ventures.
Hola, buena tarde. Hi, everybody. The purpose of this session is to share with all of you our lessons and our experience as investors into a good selection of some of the best venture capital firms worldwide. We started back in 2015, 16, so it's been 7, 8 years doing so. And I have to confess you that the original hypothesis behind this business plan back in those days have been accomplished by far. But it's also true that the hypotheses when we had the idea, are completely different to the understanding we have about the business these days. So I was suggested by the organization to come here and share with you these lessons. It's completely impossible to pack all these lessons into 30 minutes. I would probably need around 5, 6 hours, and I'm sure you don't have that long to be with me. So again, in these 30 minutes, I'll try to share with you the most relevant lessons that we have learned in this process. We are going to be talking about venture capital, and venture capital is a private asset class. Let me spend a few seconds talking about private versus public. A public market is when information flows in an immediate manner, universal manner, democratic manner, at almost zero cost. This is, for instance, stock market, public markets. Okay? Private markets is a completely different story. Information doesn't flow automatically, democratically, at zero cost to everybody at all. In fact, information is a privilege. Okay? So again, what we are going to be talking about today is something that cannot be done unless you have the experience that we have and the business that we develop. As you will see on a page that we will project right now, I am a member. Antonio, here on the stage with me, is another member of the Galdana team. And Galdana Ventures is a Barcelona-based firm that it's a division of Altamar CIM Group, which is a much bigger group that manages approximately 18 billion in AUMs in private markets in general. And we are the venture capital guys. We are the technology guys within the group. And we represent around 10% of that group. That means that we have 1.8 billion invested in venture capital firms. 90% of that money is invested into venture capital funds, 10% is invested directly into companies, always through the VC firms where we have committed. And that essentially means that we have committed into around 54 managers worldwide, US, Europe, China, and that brings us access, indirect access in most of the cases, to more than 4,000 companies. And that figure keeps growing and growing, and hopefully by Q1 of next year, we will be crossing the 5,000 figure in terms of companies where we are exposed. So again, this is a black box business. It's a black box industry. No one has any obligation to make numbers public. And that essentially means that unless you are an investor into these funds, you cannot get access to that info. So let me share with you, I'm going to be sharing some lessons, a few of them, because as I said, it's only 30 minutes. So the first lesson that I wanted to share with all of you is that venture capital, when we started the business back in 2015, 2016, it was a relatively small portion of the private assets total industry. Things have radically changed. In those days, when we had meetings with institutional investors, for instance, the answer was always the same. Listen, venture capital is a tiny portion of private asset classes. We don't invest. We are scared about what happened in venture capital in year 2000. Reality today is radically different. I mean, venture capital is mainstream. As you can see on the next page, venture capital and growth, which are the two asset classes that invest in technology, are even bigger than buyouts. In other words, I don't find anymore any institutional investor that tells me that they don't want to invest in venture capital. They have to. They have to do it because everybody's doing so, and this is where the best returns are located. As you can see, the CAGR in all these years is above 20%. That essentially means that all of us, assuming that all of us work in technology, we are surfing a huge wave. And we see no reasons to think that this will change in the coming years. We're expecting this wave to continue for the probably next 10, 15 years at least. And why has this happened? Well, this has happened because most of the technology companies are changing our lives and are changing the structure of the economy and the society. As we can see on the next page, this is a ranking of the 10 biggest companies of all sectors in years 92, 2002, and 2023. Those in blue are technology companies. So essentially, in year 92, only one technology company was within the top 10 biggest companies, and it was IBM. Essentially, only 10% of that ranking was technology companies, and the weight of that ranking in total was 500 billion. So in year 2002, the percentage of technology companies has grown to 20%. And we have a new company at the top, Microsoft. We have one at the bottom, IBM. But look at the big change that has happened in the last 20 years. We have 8 companies, technology companies, heavily dominating that ranking. And one might eventually argue that Berkshire Hathaway has around 10-20% in technology. That's why 80% of the ranking is already technology. Our view is that in the coming 10-15 years, this will even go higher. And I'm not referring to the top 10 companies, but to the top 1,000 companies. Probably 60-70% of them will be technology companies. So a big lesson to me was that the size of the venture capital industry has grown at a much higher pace than what I thought 7 years ago when we started the business. In the next page, the second lesson is that when we started back in 2015, venture capital was essentially about Silicon Valley. You had to be into Silicon Valley venture capital firms, and they used to invest into Silicon Valley technology companies. That was where the money was being made. This is radically different these days. As we can see on the next page, the dispersion of successful stories is unbelievable. And this has to do with a very strong idea. As you can see at the bottom, geographical concentration of capital and talent is highly uncorrelated. That essentially means that capital is highly concentrated in several hubs: Silicon Valley, New York, London, Nordics, Berlin, to mention a few. But talent is much more dispersed. And I would say that this is different based per stages. Probably in the seed and early stage, capital tend to be more correlated to the talent hubs. So a clear recommendation to entrepreneurs is that when you are raising a company, it's natural to have initial conversations with seed and early stage investors locally. But if your company is a really successful story, at one point in time, you will end up talking to international investors. Because again, the correlation at the more mature phases is significantly lower. So again, one lesson to me was that when we started the business, it was all about Silicon Valley, while nowadays it's much more dispersed, which is good for the digital revolution and for all of us. That's why we are so diversified. 50% US, 30% Europe, 20% Asia. Next lesson. Best metrics in venture capital are concentrated in the US. If you try to look for great VC managers or try to look for great successful stories in abroad, you will fail. That's not true anymore, and that's good for all of us. If we take a look at the next page, for confidentiality reasons, I cannot share our metrics, okay? But this is a TVPI comparison within our initial fund, Galdana 1. TVPI is the multiple to capital deployed. So that essentially means that if our TVPI in the US is, let's say, an index of 100, Europe is 25% higher, and Asia is 10% higher. But let's take a look at liquidity. So again, if US, this is DPI. The DPI is basically how much funds have been able to return to the investors. Again, if US is 100, we see that Europe is clearly below, 72. But if we take a look at Asia, it's 109% above US. In our view, you have to be extremely well diversified to compensate one to each other. But it's very clear that it's not a story about US anymore, only US anymore. Now you have options to invest in Europe and Asia and obtain fantastic results on both TVPI and DPI. Let's go to the next lesson. Investment pace has slowed down in the last 18 months. Yes, significantly. Very significantly. And this has a lot to do with the macroeconomic environment. Inflation went up, interest rates went up, and this has changed completely our world. And I'm sure that you can all face it when you make comparisons to your life today between today and 2 years ago. So let's take a look at what we are seeing these days. This is the percentage of the capital that we have called to our investors in each of our three funds, Galdana 1, 2, and 3, at the same age. So for instance, in Galdana 1, we have called approximately 85%. But we are comparing what's the percentage, that capital that was called when each of these three vehicles were 13 quarters old, which is what Galdana 3 is today. And as you can see, Galdana 1 was calling capital more frequently because more investments and more capital increases were taking place. Galdana 2 was starting to suffer a little bit for the increase in interest rates. Galdana 3 has suffered intensively that effect. The whole industry, and in our case very significantly, we are hoping that the inflation will be taken under control in the coming few months, and the interest rates at one point in time will start to decrease, which will alleviate this situation a lot to ourselves and to many of our investors. To be honest with you, when I started this business, I could never imagine that venture capital could be so correlated to interest rates and inflation. I thought that companies were about to bring innovation at a level that would make them completely immune to the macroeconomic scenario, and this is not the case, as we have learned. Let's go to the next lesson. As we have seen, technology companies are dominating the rankings in terms of size. In fact, we can say that technology is probably the biggest source of value creation in the last 25 years. And our belief is that will continue being so for the next 20, 25 years. But within this period, we have seen plenty of waves of new innovations that were taking the lead in terms of investment activity and investment returns. We had the web back in the 90s. We had the iPhone and all the applications, the application business around the iPhone and other smartphones. We had software as a service. We had cybersecurity, blockchain. Is there any big wave dominating the investment landscape these days? Yes, artificial intelligence. Artificial intelligence is here to stay, and is here to stay and be really, really big. In fact, we are seeing a low investment pace in most of the sector, but there's one exception within that picture, which is artificial intelligence. In artificial intelligence, companies, successful companies, tend to be very active when it comes to capital increases. Valuations go up significantly, and the appetite of the venture capital firms to invest into these initially successful artificial intelligence companies is unbelievable. As you can see here, there's a significant increase in terms of the weight of artificial intelligence within the US venture capital investment activity. It's also our case. As you can see, it represented 11% in Galdana 1, 12% in Galdana 2, 20% in Galdana 3. And this is only those companies that are 100% artificial intelligence. Because probably the biggest impact is not how big is this tranche of the pie, but how many of the other 80% have something to do with artificial intelligence. Probably they are not a pure artificial intelligence company, but their business model could be heavily accelerated by artificial intelligence. So again, artificial intelligence is here to stay and will be very big, very big. I can tell you our lives will change 100%, and our companies will be benefited or affected by artificial intelligence in a way that it's even harder to imagine these days. In fact, I was in Silicon Valley 10 days ago, and I was having conversations with founders and investors into artificial intelligence, and there was a common theme when I asked them about what they are expecting for the coming years. And they said, listen, there's only one certainty, and the only one certainty is that this is going to be huge, huge and imminent. Apart from that, we have more questions than answers. So our assumption is that there's going to be big winners, big losers. There's going to be a lot of activity in artificial intelligence in the coming years. And you will notice that our life will be very different and very much affected by the introduction of artificial intelligence in our personal and professional lives. Next lesson. It was not that clear in our view back in 2016 that business models could be that different when we compare them by regions. But to be honest with you, what we have learned after 7 years in the business is that there are substantial differences per regions in terms of business models. This is our internal tool. This is a tool that we use in order to track the business. Okay? And obviously, we've changed some pieces here and there because we cannot share information as transparently as we would like to, but it will be enough to share the lesson that we have learned. So here on your left, you have the 3 main geographies where we invest: US, America, Europe, and Asia. As you can see, it's approximately 50%, 25, and 25. And this corresponds to Galdana 1. Recently, in Galdana 3, for instance, America has grown a little bit, Europe has grown to 30%, Asia has gone down to 20%. On your right, you have the main business models, B2B versus B2C. So as you can see, at a Galdana 1 level, B2B represents 59% of the total cost of investment, while B2C represents 34%. But let's take a look at what happens when we click, for instance, in America. As you can see, when we click in America, B2B goes up significantly, which essentially means that the technology sector in America is heavily dominated by B2B business models. And this is a trend that started a few years ago, and we believe that in the coming years, it will continue growing. So B2B in America in the coming years will probably represent around 80%. What happens if we click in Europe? Pretty much the same to overall Galdana 1. So B2B still dominates, but not as much as in the US, 56%, while 31% in B2C. What happens if we click in Asia? Boom, B2C dominates. So that's a significant change compared to what happens in the US. And that has an impact on our activity. When we select the best VC firms and we go to the US, we need to talk to VC firms that are very experienced and successful in B2B, as you can imagine. While in China, nowadays, still nowadays, when we talk to the best VC firms, we hope them to be very good in B2C, because this is what you have to do in China. Our expectation is that as long as the Chinese economy evolves, there will be a balance in favor of B2B versus B2C. And that probably will take 5 to 7 years to happen. But we will see that at the end, B2B will also dominate in China. Again, that was a big lesson that I learned. I never imagined that differences could be that big. Another lesson. Technology is a huge umbrella, where multiple sectors and subsectors are well represented. That essentially means, I presume that there's a lot of entrepreneurs here in the room. I'm sure that you guys have heard 100 times, 1,000 times. You need to be focused, which I support, by the way. You need to be focused. Success is very much aligned with focus. So what you can see here is the level of granularity that we can obtain when we invest in so many VC firms in different regions. It will appear the Wi-Fi is we need to push a little bit the Wi-Fi network. But essentially, we can distinguish 5 industries where we are committed. Essentially, we are committed into 5 industries. We are committed into 50 sub-industries. We are committed into 400 sub-industries. And that's the level of granularity that we obtain, and that's the level of focus that we see that it's very much correlated with success in the best technology companies worldwide. And the amount of information we have about all these 5 sectors, 50 subsectors, and 500 subsectors is incredible. The color of the size of the box represents the weight of that sector at a cost level. The color of the box represents what's the average multiple that we are obtaining into that particular sector or subsector. The darker the blue, the higher the multiple. The darkest blue means that we are above 5x in that particular subsector. If it's orange or if it's red, it's because we are below 1x. Okay? And that allows us to gather a lot of information about, again, sectors, subsectors, subsectors. For instance, if we click in consumer and retail, and if we click in gaming, for instance, we will see that gaming is broken down into multiple subsectors, and we can see that the average multiple that we are obtaining in each of these subsectors is different. So, again, my suggestion to all of you, as you have already heard, probably hundreds of times, thousands of times, be focused. At a global level, you will be for sure competing against many other people. So be as strong as possible in a very particular niche. And from there, try to grow as much as you can. But don't try to do too many things at the same time. Again, this is a big lesson. When I started the business in 2016, I thought that obviously, tech sector wasn't not enough to describe the digital revolution. I could never imagine that there would be something like 400 subsectors where people tend to compete, Next lesson. Initial asset selection is a very important factor to explain the long-term success in venture capital. But it's not enough. It's not the only one. Something we thought back in 2015-16 was that best VC firms are the ones that enjoy the best deal flow and have the best teams to materialize, to make the selection within that great deal flow. And this is partially true. Probably 70-80% of the success of venture capital firms is explained by quality of deal flow, good selection within that deal flow. Good. But it's not enough. Because something we have learned is that once you have committed into companies, you will progressively discover, probably in the first 6 months, first 12 months, that some of them do really well, while some others do really bad. And the best venture capital firms are the ones that are able to, once that year has passed, decide what are the companies that deserve to double down the amount, which ones are the ones that deserve to be killed. Sorry for being that strong. My big suggestion to entrepreneurs, when you've been able to convince a good VC firm to join you, this is only the first step of a long race. You need to keep convincing that VC firm, that investor, that you deserve their money and the next money that you will want from them in the coming years on a daily basis. There's nothing worse for a company and for an entrepreneur to convince a good VC firm one day, but not when the next round comes in a year after. Because everybody will know that that VC firm has not committed again into that company. And that VC firm knows extremely well that company. This is, again, we're jumping into our internal tool. I mean, you see the boxes. The size of the box represents the size of the value we have into each of these companies. In Galdana 1, we have 1,400 companies, okay? Again, the size represents the value, the color represents the multiple. And as you can see, this is highly dominated by all type of blues, which is good. But, let me tell you, being a partner at the VC firm is a tough business. It's a really tough business. Sometimes you end up having this kind of family of colors, and this is fantastic. But this is only the end of the game. Let's take a look at the same analysis when we compare by cost. So when we compare by cost, the same managers into the same companies have this family of colors. Now you can imagine that VC firms and partners within VC firms had a very strong heart, because they need to be prepared to very successful and unsuccessful stories. And again, this is another lesson that we've learned in this business since we started back in 2016. I think that we have finished. Let me go back to the original page, the one that describes ourselves. What is our plan? As I said, we are managing 1.8 billion into the very best VC firms worldwide, which gives us exposure into thousands of companies. Our intention, as I said, the VC and growth businesses are growing by 23% annually. So our intention is to keep growing at the pace we've been able to do so since 2016. Our intention is to be at somewhere between 6 to 8 billion in the coming years. We've been able to get into the very best names, which was not easy at all, but now we are already into them. So now it's time to consolidate and grow our position within these great performers. That's why we believe that we are going to be able to grow our business from 1.8 billion to somewhere between 6 to 8 billion in the coming years. And everything is done from Barcelona. We have, as I said, we are exposed to VC firms in US, Asia, Europe. Our investors come from multiple continents. So in a way, we are intermediaries between investors, institutional and family offices that are located in Europe, America, Asia, that want to be exposed into these great VC firms through a little team of 12 people located in Barcelona. And to be honest with you, being located in Barcelona has been instrumental to explain our success. Because there's plenty of geopolitical tensions these days between China, US. It's very hard for a North American investor to invest into the very top Chinese names. It's becoming tougher and tougher. At one point in time, it will be probably impossible. It's equally impossible for a Chinese investor to invest into a US VC fund these days. The fact that we are based in Barcelona, which is a city that generates a big smile every time we say that we come from this city, has helped us a lot in being able to build up this amazing portfolio. So again, to summarize, what we have learned in this 8-year process is amazing. Luckily, we've been able to navigate this learning process in a very good manner, because the understanding about the business we had back in 2016 is radically different to the one that we have today, based on these 8 years of experience. I think that's all. I have nothing more to share with you. Thank you. Thank you.
Moltes gràcies. Gràcies, Marcel.